Hey there, Blockhead Traders. Here at Blockhead Traders, I must inform you that we are not financial professionals. Nothing we say should be considered financial advice. We offer our own thoughts and opinions to you, the viewer. We expect you to take these opinions, form your own financial conclusions, and make your own financial decisions. This is Blockhead Traders for the week of June 22nd, 2025. And in this week's episode, we are going to talk about a market edge. And I'm joined by Viper XL007, and we're going to discuss whether or not an average retail trader like you and I might be able to acquire a market trading edge. But before we hop to that, I want to give a shout out to our Discord, link in the description below. You can hop in there, say hello to myself, Viper, some of the other Blockhead traders. Love to hear what you're trading. Love to hear what type of content you want to hear about. Also, you'll find a link to thetagang.com/sprocket888, where I post each and every one of my equity trades, the good, the bad, and the ugly. Viper XL007 is also there with a /Viper XL007. Last, this is available in an audio-only format wherever you get your podcasts. So look us up, subscribe, and if you can't find it there, let us know and we will get it there. But let's hop to this week's content. Viper, a market edge, a trader's edge, an investor's edge. What the heck is an edge? And to put that really quite simply, an edge is simply a statistical probability where the odds are slightly more in your favor than not. So if you flip a coin and you got a 50-50 shot, there is absolutely no edge there. But if you do something to weight the coin a little bit to one side and you get a 50.000001% chance of coming up a certain way, that is considered an edge. And so the idea here is that any sort of market edge or trading edge is anything you do, anything you know that is going to push the scales of probability ever so slightly in your favor. Now, the stronger the edge, the stronger that probability will go in your favor. And it is something that everybody is always kind of seeking and looking out for. And you might hear things that says, oh, yeah, you can never beat the big time traders because they all have inside, they all have their edge, their own, this, that, and the other thing. And really, that might be discouraging to you, kind of a retail trader looking into that, saying, well, the cards are stacked against me. The odds I can't win at this. And I think that's when it really comes down to kind of looking for what is your edge. And to me, an edge isn't necessarily, my edge is not always the same edge as you, Viper, which is not the edge that other people have. And I think what we really kind of want to address here in this episode is what do we do, you and I do as traders, that basically give us higher confidence and higher probability in our wins. And I won't go into too much around my side because I think you have quite a bit to talk about when it comes to your perspective on this edge. But I would say that mine was deeply, deeply rooted in the journaling of my trades. And so I had a particular strategy that was to sell volatility, which inherently has a probability already in your favor. And so that kind of started off with a slight advantage to me. But journaling allowed me to record multiple different trades, multiple different parameters of those trades, multiple different characteristics. And then it was kind of looking back through those and said, what do the successful ones have in common? And what do the unsuccessful ones have in common? And can I tweak and iterate my strategy around trying to get more of those characteristics that I found to be successful in the outcomes and less of the ones that turned out to be not as successful. And so constantly refining that, it wasn't a one-time process. It was a continuously iterative thing. As you get more and more data points, I constantly refine that. And then you start to develop your trading strategy. And then that trading strategy inherently has an edge, hopefully. And that is that probabilistic tilting in your favor. So Viper, I don't know what your opinions are on edge or what you have historically thought of when you heard of market edge, trader's edge, things like that, and how relevant that is to the things that you're doing now. But fill us in.
Yeah. So I think you captured it really well at a high level there. And I think in my journey, The edge was always this idea that I think is really easy to grasp. Like, I mean, anybody, even if nobody's been in the market, you just hear the concept of having an edge, and you're like, well, yeah, of course, I want to do that. That makes sense. I'll win more if I have an edge or whatever. But then you get in and you start playing around and you start doing all of the safe entry ways we talk about as far as position sizing and yada, 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 all that stuff. You start putting money on the table, but you very quickly will realize that the edge is not built into the market. the The edge has to be found, and it's sometimes not easy to find. And so the way that I came to the edge that I'm about to talk about here was literally just eyes open, ears listening, cruising around, absorbing information. This exact video, if you're watching it, I hope that, nothing we say is financial advice, but I hope that, as with all of our episodes, that it encourages you to dig deeper on something, that little spark, something, some little blip catches, because that's my journey, my personal journey. I mean, I've watched a lot of really bad videos. I've watched a lot of really clickbaity, make millions of dollars or whatever. Like, I mean, I totally trashed my YouTube algorithm, but there were tiny little.
None of those videos were on Blockhead Traders, by the way. None of them.
Because we have the same thumbnail. Nothing sensational here. But I don't regret trashing my algorithm, because there's little bits here and there and there and there that you can pull together your edge, whatever it works. So what I want to really impress is I'm not advertising my strategy as like, this is the thing you should go do this and voila, like we're going to make it. I'm going to go deep through my strategy, but again, what I'm trying to impress upon is just the methodical nature of how I'm turning through it. And the giant asterisk is I don't have the real-time trading data to back it up yet. And that's the hard hat part of this, where I feel like Sprocket, I feel like you developed your edge by getting in there. You had, I think, so the other thing I was going to say is I feel like you had two edges. One was exactly everything you talked about, the journaling and whatnot. But the other edge is actually the same exact edge that I'm going to talk about here, which is elevated premium selling. That presents, I mean, just that concept, elevated premium before earnings, or, just that, the fact that situation exists, that's an edge if you can spot that, and then you can leverage it and more smartly sift through the data and find the real gem of plays in that. So what I want to impress upon is the methodical nature of finding the edge and tuning the edge, not necessarily exactly what I'm doing. So with that said, I want to let's jump over real quick to a chart, because I want to just reinforce the capital E edge that where this all starts, which is earnings volatility crush. We've talked about it a lot, and again, it's earnings events being binary, but earnings events being a deflation of a big swollen balloon, and that balloon's going to pop. And how can we use that to our advantage? So all I wanted to show on the chart here was not necessarily the chart itself, but I'm showing aftermarket hours on the chart. It might be a little hard to see on the screen, so let me just toss this box up here in a nice green color here. And so my particular strategy, which is, I think, very well defined and tuned, but I'm at the point where, like I said, I'm now starting to take active trades using it. So now I can get that final key piece of data, which is real world trading data, to confirm or debunk the strategy. But So the idea here is this green box is the after hours between trading days. So let's pretend like on the right side of the box is morning earnings for this particular ticker, KMX in this case, because this is a trade that I just took today, which has earnings on Friday and market closed tomorrow. So everything we talked about with volatility crush is that it happens right here in this green box. You have the market, I mean, all the days leading up to here, this volatility is elevated. The market is just tingling with anticipation for a major news event. And then we go into after hours and it's kind of lights out as far as on the options chain and most trading ability. And then while the lights are out, the earnings event happens. And then market opens the next day and boop, the lights come on. And as the market settles into that new day, that new reality, all the volatility has been zapped out of that balloon because the event is over. And so my particular strategy is almost like a super concentrated version of Sprockets. And so what I mean by that is both of ours have the same idea. How do we capture that collapse, aka short the volatility? How do we capture that? Sprocket has his approach, and then the approach that I am currently refining is, okay, what if we get like super cutesy here and we literally open a trade, a very, very specific trade, just before the market closes, and then boom, we close it just after the market opens. And so now we are completely containing our blast radius of open the trade, volatility crush happens, close the trade. And we do that reliably, consistently, methodically, and profitably, capturing that volatility crush there.
You know, Viper, what you said there actually really, I think, when you're talking about the two edges that I had, I agree with you, but I think that I see it as a further refinement of the edge, right? So the way that I view it, as I started off selling premium, where it's statistically in your favor that, you know, time is working against it. And you'll hear us go back in previous episodes and say, when you short premium or when you sell premium, you can profit in two of three directions, you know, going nowhere or going up or down, whichever you play, right? Versus if you buy stock, you can only win in one direction, and that's going up. You don't get to profit from going nowhere. And that's the added dimension that selling the premium gives you. And when I said I journaled, I was out there selling premium left and right. And then I started to hone in that I was more successful when the premium was extra high relative to its history. And that's where that data-driven approach of looking at my trades tilted me to, wow, I do a lot better when that premium is already over elevated, because there is more of a probability that it's going to deflate, or that something is going to come out there and go down. So yeah, I agree with you. You can consider it as kind of two edges, or it's a further sharpening of your existing edge. And the other thought that jumped out to me as you were kind of talking about tightening this up to your more narrow strategy of kind of holding overnight and looking for that vol crush, that's actually where I started trading earnings. And I was very successful at it. And the idea is you put it on at the last possible minute, so the rest of the market fluctuation you're never impacted by, and you take it off as soon as that volatility is out and gone. And I don't do that so much anymore. And you might be like, well, why? Was it a failure? No, it wasn't a failure. The reason I don't do it is, one, the total premium collected I found could get a little bit bigger and better if I was opening it for the whole week. Because, you know, there is a lot of volatility, but there's also a heck of a lot of volatility and premium baked in 2 days before their earnings, right? And so that's where I started saying, well, let me go ahead and try to capture that, because what I started to notice from my data-driven approach is not a lot of the stocks really wavered much going into earnings, or if they did post earnings, they ended up kind of reversion to where they started with at the beginning of the week. So not really anything, hard evidence, but the real reason that I started to switch is I just didn't have time to make sure I was available 15 minutes before market close to open up the trade. And it was a lot easier for me to open up the things at lunch on Monday morning for expiration on Friday. And once I learned over time that really early assignment is just not a thing in earnings weeks at all, I knew I could always do my rolls at lunch on Friday. So to be honest, a lot of my deviation from tightening it up simply came from my availability to hit a trading window throughout the week. And it was lunch on Monday, lunch on Friday.
Which is definitely an important point as anybody's considering any strategy is you really need to consider that execution level of it. Because exactly like you just said, the best laid strategy in the world is no good if you can't reliably execute on it. So there were two things that you said in there, which I think are really important and help us move to the next step of refinement here. The first thing was elevated premium, and the second thing was rapid decay. So let's jump over to this dashboard, which I think I kind of flashed before. I've definitely talked about it. But essentially, as I'm scanning for plays, what we see here is this middle column. Let me line this up a little bit so it's just a little bit easier to see there. This IV-RV column here is going to be the elevated premium part of the equation here. So the higher this number, the more elevated that premium is going to be. And keep in mind that to go from a red X to a green check mark, that threshold is 1.25 in the particular math that I'm using. So, I mean, this Halion HLN at 2.51 is insanely high. This NAT Nordic American Tankers Limited at 1.71 is insanely high. So very attractive. So that is the elevated premium piece of it. The TS slope is the term structure slope. So I talked about this before. The term structure slope is basically saying what is the slope of the line between, and because I'm using a calendar spread, which we talked about before. So I don't want to get too lost into the weeds here, but the calendar spread is a horizontal spread of the same exact strike of an immediately after earnings expiration on the options, and a 1 month after earnings expiration. And so it is a spread horizontally because you're using the same exact strike on both of those. So the term structure slope says let's chart the IV of the front month, the really short one, the really elevated one, and let's plot the long month, the 1 month out expiration. And we're gonna see a delta here. We're gonna see a slope down because the first one, like we keep saying, is elevated. The back one is not. The back one is more nominal. So what is the slope of that line? The sharper the slope, the more rapid decay on the volatility is expecting. The market is expecting. So if you have a really slow slope, then the market, even if it's super elevated, but you have a really slow slope, the market is expecting elevated volatility to persist all the way to that back month. If you have a super sharp line, then the market is expecting that pop of the balloon to happen extremely quick. And that's the scenario we want. So the slope of the line is super important because you can be elevated, and this goes back to what Sprocket was saying about refining and finding high quality setups. The high quality setup here is a combination of is the IV elevated and is the term structure slope steep. And then we're also on the screener, this next column here, expected move. That is using the spread pricing of the options chain to derive what the market is expecting the move to be, because that is what's driving the elevated volatility. Is the market is expecting a volatile move. So we're pulling that data into here as well. So here we have we're starting to hone in. We're bringing it in of, all right, do we have a really favorable IV? And let's take, I mean, we'll look at both of these, HLN and NAT. These metric based, they look phenomenal. 2.51 IVRV on HLN, 1.71 on NAT. The term structure slope, keep in mind, again, the threshold to go from red X to green check mark, which is a semi-arbitrarily chosen value, but it was from the person that I had learned this strategy off of. It was a very thoroughly tested, arbitrarily selected value. So the term structure slope, where this goes from fail to pass, is negative 0.004. And so you can see in both of these cases, I mean, HLN is a full 10x better than the threshold value. And NAT is significantly better as well at negative 0.01. NAT has an expected move of 4.39%, which for a lot of baked-in volatility, 4.39% expected move, that, again, this is feeling very favorable. HLN is expecting a 14.1% move. So both of these at this point are honing our window. And up until recently, that was my threshold. That was what I was looking at. I was like, this is perfect. I'm filtering high quality setups. So let's go. And I would pull the trigger on these, and I was getting profitable. I was getting around a 60 to 65% win rate, which is above 50%. So if you're able to execute the same position sizing over and over, that's a win. However, there were some anomalies that kept popping up, which aren't worth enumerating now, but just summarize it to say that there were a lot more outliers than I statistically expected. So there were two things then that I was like, we need more data to help refine this. The first thing in talking to Sprocket was Sprocket's shouting from the rooftops, mountaintops, liquidity is king. And so if we spoil some of the end game here and scroll over, I added this liquidity score where the screener here is actually going out and it's scanning the options chain, and it is grabbing it is calculating a liquidity score. And so it's looking at what is the pricing spread of these options, and not just of these options, but what is the pricing spread to open a calendar spread, because you need both front month and back month liquidity to be able to open this spread. So it's doing that, and then it's deriving this liquidity score. I spent a lot of time cranking through and tweaking that and testing it and tweaking it. And so now things really start to fall apart. I mean, not fall apart, but just we're starting to realize why things get wonky. You can see that this HLN has a liquidity score of 0. And
that sounds terrible.
Yeah. And NAT has a liquidity score of 3.8. And so the key driving factor of this is, again, that price spread. So what is the spread, and then what is that spread ratio to the cost of the underlying? You can see, I mean, I don't think either of these would pass Sprocket's sniffer test immediately, because you can see HLN here has a ticker of $10.45. NAT is a ticker of $2.85. When you're really down in the bargain bin like that, I mean, sure, there are options plays to make, but you got to be super specific and probably super naked to make anything work at this point. Spreads are complex orders, and spreads require extra liquidity, and you're just not going to find that at these lower cap levels. So we can already see now a very important a very important thing unfolding, which is, hang on a second. I mean, HLN, like average volume, 17 million volume. I mean, this threshold of volume is 1.5 million, which is especially to Sprocket's strategy, that is way too low for his liking. But even to his standards, as I recall, 17.8 million volume is a huge thumbs up. That's and this is stock volume. This is not options volume, which is something a good differentiator to keep in mind. But IVRV 2.51. I mean, this thing looks smashing on the metrics, but you go to the liquidity, and nothing matters if no one's going to fill your order. Step one. And so that filters out. Now we're really honing the needle here. So we say, okay, NAT 3.8 liquidity. Okay, so it's not great, but we could get fills. We could get prices. So what next? And so this is the three metrics plus the liquidity score is where I sat for another good while. 2 or 3 weeks of taking trades, earnings trades with just those metrics. And it was better, but it wasn't, it still, it felt like I could do more. And this is the first flashing of a warning sign. As you're developing a strategy, you're always going to feel like you can do more. You're always going to want to do more. And that is a danger because there is this thing of overfitting a strategy. And overfitting means you're just trying to cram so many things in because in the back of your mind, you just want confirmation bias. And so you're going to keep cramming things in here until it tells you what you want to hear. And now you're overfitting the strategy, and ultimately you're going to lead to analysis paralysis where, either it tells you what you want to hear and it's completely broken, or it has so many data points in it that it just is giving you too many options, too many paths forward. And then you're going to be like, I don't know what to do with that. So I wanted to figure out what's my last little, my last little chutzpah of what could make this just a little bit better. And there's this thing out there called Monte Carlo simulations. And what a Monte Carlo simulation does is it's just running a set of alternate and possible scenarios on a core model. And then it's doing that as many times as you want. And it's simulating all of these parallel possibilities and then, reporting back what happened over those scenarios. So, I mean, as you can tell here, I have a pretty solid core model here. IV-RV elevated, term structure slope steep, expected move. We have a percentage point of possible moves for this price. And so that is a fundamental model that you could build a Monte Carlo simulation around. You can say, here's my IV-RV, here's my term structure slope, here's what the market is expecting the move to be. Now go forth and simulate within those confines and from a baseline of these values, but then also deviate around these values in all sorts of different directions. So that's what I did. I built out this Monte Carlo simulation. And what I loved about the exercise is the fact that, like we always say, options data is so statistically driven. I had way more information than I ever expected. I mean, even though it's literally right in front of me here, because as I'm building out the Monte Carlo simulation, I was like, wait, well, we could simulate the decay. We could simulate the vol crush because we have the term structure slope. The term structure slope is quite literally the rate of decay between the front month and the back month. So start with the term structure slope, start with that slope of the line, and then now let's simulate what happens one day after on that line slope. We have the expected move, 14% on HLN or 4.3% on NAT. We can say, what happens if we move 4.3%? What happens if we move 6%, 2%, 5%? on and on and on and on. And like we have all this data here. So I built the Monte Carlo to harness that real start point and then simulate smartly around that. And so in the case of NAT, so obviously HLN, boom, that thing's dead on arrival because the liquidity chain is absolute rubbish. So NAT, okay, fine. We check the chain, we can get our fills. So let's see what we got. And it looks good. If you can get the fill, it's got really good metrics otherwise. So we run the Monte Carlo simulation on it. And all of a sudden, I mean, we see this 50.37% profitability is the ultimate result, the ultimate summation. If I hover over it here, you can see, though, there's percentiles. So when you run the Monte Carlo, you have the, I'm calling out the 75th percentile, the 50th percentile, 25th percentile, which is just basically saying of every model, of every simulation run, the 75th percentile, so the runs that fall into that 75th percentile experienced a 7.14% return. And then you can see the other numbers there, 50th and 25th. So not great. I mean, you're kind of going to, statistically, you want to see the 50th and the 75th percentile to be favorable enough to be worth your time and effort. And honestly, breaking even or a 7% profit, I mean, those just aren't, that's not really that attractive. And so I also had the Monte Carlo here go ahead and chart. So I'm doing 10,000 simulation runs. And step number one, we do see a nice bell curve here. So, I mean, that is working as far as statistical data. But the median average of all 10,000 runs, I mean, it is just smack dab splitting down the break even middle. And so this just is not, it's not working. There's too many probabilities stacked against me to want to take this trade. So real quick then, this was an example of trades that met the initial criteria. They surpassed exceptionally the initial criteria. One of them drops dead once we consider the execution. The other one is hanging on by a thread. And in the real world, maybe we just would go ahead and take this trade and then it would end up being a loser and we would have to chart that down. The simulations now add one more edge to say, know what? We're just going to sidestep this thing altogether. And we're just going to move on. So, what does a good result look like? If I go ahead here and move to Friday's expiration, Friday's earnings events, which I happen to know, for this week, it was the only day. Friday was the only day that had anything worth anything.
Is a really, really light week in earnings.
Extremely light. I mean, this scanned 21 tickers on Friday. During peak earnings season, that's a 350 ticker screen. So yeah, extremely light. I honestly didn't think I was taking any trades this week. Even in the Discord, Sprocket put his list of things he was taking. And I was like, yeah, I don't think I'm taking anything. And then I normally don't even screen Friday because I don't know. I feel like in my head, earnings are after hours. And I was like, nobody's announcing after hours on Friday. But I screened it and hey, surprise, there are after hours, but there are a good number of before market. And as we can see here, as the screen results come back, there's some really nice green here. So, KMX is what started this whole thing. So this thing is just looking teed up. I mean, extremely teed up. So we can see 3.3 million on average volume, $64 ticker, 1.42 on the IV, negative 0.025 on the term structure slope, and a 9.48% expected move, and then 9.1 on the liquidity score. So bang, 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 bang. We are hitting on all cylinders here. Good liquidity, good execution, and again, you can't overemphasize liquidity is king, especially in this strategy, because remember, my particular strategy is based on get in on the final 15 minutes of market, get out on the first 15 minutes of market open. If there's no, I mean, those are peak liquidity times. And if there's no liquidity at those times, I mean, you're toast. You're gonna get slipped to oblivion. So 9.1 on the liquidity score for KMX. 89% of the Monte Carlo simulations had a probability of profit. I'm sorry, 89% is your probability of profit. And if we look at the Monte Carlo, you know, I don't know. This thing looks too good to be true. And honestly, I'm certainly not saying this is perfect. I mean, this is where that real world data is going to back this up or disprove it. So two things happened at this point as I'm tuning this. So I spent a lot of time getting the Monte Carlo simulations realistic. Initially, it was all messed up. I was getting tons of horrifically negative results. Then I was getting flip side, tons of overly positive. And, you know, I just kept tuning and tweaking and running things through my BFF Claude, the Anthropic LLM Claude. And so when I got this result, you know, I'm skeptical. Rightfully so. Anybody should be skeptical at a perfectly green result. So two things that I did here, and I mean, this is just in the moment, so I can't even tell you if it's good or if it's right or not. But step one is take the trade. Like, I have developed the system in a very thoughtful and intentional manner. I am pushing on the border of overfitting. So take the trade. So that's step one. Start to get that real world data to back up all of that legwork. Step two, because we're living in the age of AI now, I was very skeptical of this. So I went to my BFF Claude and I gave it, I took a screenshot of this chart. I took the code that generates this. Now, again, not everybody's going to be comfortable throwing their code into the ether, and probably someone's going to take it or do whatever they want with it. I personally don't care. To be fair, Claude created this code. So I'm just going back to the author. So I took the code, I took all of my tweaks to the Monte Carlo, I gave it all the code, and I gave it this result. And I said, am I missing something? Is this as too good to be true as it looks? And it went through a very thorough breakdown of no, it's not. It is a very good looking result, but it is based in statistics. So no, that doesn't mean it's going to work. But it has all of the checks, all the boxes checked as far as go ahead and do this. And yes, there's always going to be a chance of complete and utter failure, but it's at the point where take the trade. So without harping on that too much, that is where I'm at. And again, the purpose of this journey is not to say you need to go do all of these things. This is just particularly what I decided to do because it was enjoyable to me. And I knew how to do it. The main takeaway here is find an edge that speaks to you and then falsify the edge. Prove it wrong to yourself, and then prove how you can fix that and just continue to grind it and iterate it. But also watch out for that overfitting risk. Watch out for that analysis paralysis. Be very real with yourself of when it's time to just take the trade, because at the end of the day, I'm going to end up exactly where Sprocket started, which is just take the trade and start to analyze historical performance. And in my particular case, I have packed my bag with all of the statistical data So when I'm analyzing that historical performance, I can immediately pair it up with, did this work or did it not? Did my results wildly deviate from the expectation, or are we consistently hitting in line with the expectations of the data that I've put together here? So hopefully, like I always hope, a tiny little snippet, seed, something of all of that stuck out. And not that you feel like you need to go recreate this entire thing. Just take that seed and start building something that is going to be your proven edge that you can find. Because to answer the question from the top, yes, every single trader, no matter how small, has an edge. It's just the way the market works. It's the way the wild ocean works. Every tiny little piece of life in the ocean exists because it found an edge to survive. And that's on you to hunt that out.
Yeah, definitely, Viper. And the one thing I'd kind of like caution, or not caution, but kind of just comment on the whole thing. Like you have done a very in-depth, thorough approach to this, and by no means does anybody need to replicate generating their own code screener with Monte Carlo simulations and tweaking that and the other thing, right? I just started with an Excel sheet and I wrote a bunch of things down and I reflected on it. And it's really what speaks to you, like you mentioned. If you're the type of person that drives into this, and go for it, right? Finding your edge is about what speaks to you and how are you tweaking and constantly iterating to look for more of the good and less of the bad, and just keep refining.
Yep, absolutely.
So that brings us to the end of this week's episode. And really, I equate this to cooking, right? Everybody has their own flavor of dish they like. Everybody has their own style of cooking that they like to enjoy. And the market is big enough to accommodate all those things. And finding the edge is about refining that recipe that you like to enjoy. Do I need more salt? Do I need more Cajun spices? Do I need more pepper? Do I need more garlic? Ooh, wow, I don't like, vegetables, or I don't like meat. I need less of that. And that's really what this is about. It's about finding what is the dish that you typically like to enjoy, and then the edge is refining that dish to your palate. And however you do that, if that is experimental cooking, then great. Then that's what that is. If that is researching YouTube videos and food critics on their opinions before you take a dive as far as what you want to try next, then that's that. But at the end of the day, there is no mythical, magical thing that's out there that's unattainable by you. I mean, every trader that's out there, whether they're professional, non-professional, retail, retirement trader, young trader, right? Everybody is able to acquire information these days. This is the age of information, and so much is out there and so much is available, and it just takes the motivation, the drive, and the determination to go after it. And work towards it, because it's all out there, but it's not for free laying on, like you got to work for it. No one's going to hand you the magical solution and say, here you go, sir, do this and you will be wildly successful beyond your dreams. It's just not going to work that way. And if you don't have that desire, that drive, that determination, you won't be met with success. And it's not because the odds are stacked against you. It's not because you're incapable. It's all about how motivated are you, because it is attainable, it is doable. So that's where I'll leave you guys. Hopefully you are out there looking for your edge and refining your strategy to what you enjoy and what interests you. Like I said, it's a little light on earnings, but there's still plenty of things out there in the market. So good luck, have fun, and remember, think outside the block.